Hey, good morning, everyone. Marty Missouri here, 18th of February, Friday, 2022, with your weekly macro update. Thinking that I'll be able to make up for last week where I kept you probably too long on this presentation. So we'll talk just for a minute about what our index score looks like this week, look at a handful of the inputs. Then I want to do a quick technical analysis of stocks, gold, and silver for you as well. Okay, so getting underway, our index dropped again a couple of points this week to 27.66. And so that's a slowing economic environment by definition. Again, when we get below zero by our measure, then we have recessionary odds going forward exceeding the odds of continued expansion. I'd say we're still comfortably above that here, but again, nevertheless, our view is that the rate of growth is slowing, and I think it makes some sense given everything that the world's dealing with right now. And there are cross currents. Of course, some things are actually getting better while others are getting worse and so on, while inflation continues to run hot. And I've talked about our expectations short term and then longer term when it comes to inflation. So we are structurally bullish on inflation going forward. But as I continue to preach, none of this is going to happen in a straight line. Everything, including inflation, is going to see periods where it's ramping up, periods where it's calming, and so on. Online retail sales ramped up nicely on a month-over-month basis, and so that scored positively in our index. Brick and mortar did as well, month on month. Annual growth rate down a little bit. The more high-frequency retail data was off a little bit week over week. So it continues to score neutral for us, but the online retail went from neutral to positive. Housing starts were off a little bit here this last month. Single-family homes were down by 70,000. Multifamily construction, which has been really hot of late, it was flat month over month. Housing permits, on the other hand, they actually continue to tick higher. Big move here, and then month over month is a little bit better. Single-family permits were up 77,000. Multifamily permits were off just a bit on a month-over-month basis. Commercial and industrial loans, which I viewed as a real positive here last month, actually rolled over considerably on a rate of change basis. So that's somewhat of a letdown in terms of borrowing, lending impulse, if you will. The cash freight index, which is probably the most robust source of all things transportation when it comes to freight movement, it rolled over hard on a month-over-month basis. Now, when you read through the report, they say that this was all about the Omicron variant last month, but the drop was so dramatic that we virtually had to take that from a positive to a neutral in our index. And notice that expenditures dropped a bit as well. One of my personal favorites, the leading economic indicator to coincident economic indicator ratio actually rolled over a little bit here this last month. No big deal, but that just says that the things that give us a picture of how the economy is doing going forward versus those that tell us what's going on the ground right now actually gave back a little bit here, right? So coincident indicators outperform leading indicators. And again, we won't get too excited over that blip. We'll allow it to take us from a positive to a neutral, but you can see what happens. We need to start paying attention going forward as the direction of this begins to change. The U.S. Economic Surprise Index is actually moving notably above zero now. And remember though, folks, this isn't necessarily improving economic data. What it is, it's improving economic data only relative to what economists had previously expected. So as they were missing the mark to the downside, right, then they started to get more negative, and now the economy is surprising them. Again, even when we're below zero here, this in no way means recession. It just means what I just described. And this no way means that the economy is ramping up a bunch. It just means that the data's come in a little better than what economists were anticipating back in here. And the Bloomberg Commodity Index continues to break out above this high right here, this recent high back in mid to late 2021. And so that's a nice, strong move to the upside. As I continue to explain, this is going to come with some real volatility. But breaking through here, certainly is consistent with our long-term thesis with regard to commodities, inflation, and so on. And then lastly, with regard to our data points in our index, the sector to S&P 500 ratios, that actually improved. That went from neutral to green because things like financials, right, above 100 means it's outperformed the S&P over the last month. Consumer discretionary stocks, material stocks, energy stocks, not industrials, that means it's underperformed. But staples, your more defensive stocks, underperform the S&P. Utilities underperform the S&P, and healthcare underperform the S&P. Utilities can, we can probably explain that largely by the threat of higher interest rates. Technology slightly underperforming the S&P. So contrary to the slowingness of our index, the market over the last 30 days or so seems to be anticipating something better for the economy, of course, and that would be bullish for inflation probably as well if this actually plays out the way this signals. But it also speaks to the heavy weighting of technology in the S&P 500. And we were having an internal call this morning, and we were pointing out that with all the fear over Russia and Ukraine, you might expect tech to outperform everything else because a Russia-Ukraine incident probably would be a weight on the global economy. So I think this speaks more to just an overall fear over the market, a real risk-off mood, people selling the most expensive things out there. All that said, I'm just looking at this morning's action, and we're an hour and a half from the close as I record this. And the S&P has come back notably from its lows. It's still down 0.5%, but it was down about 1.2% at one time. Have no idea how we're going to go into the weekend. And right now, that Russia-Ukraine situation is really moving the needle. And the other thing that's interesting about that is it doesn't seem to be inspiring any let up at all from the hawkish Fed governors who are saying they're going to have to be more aggressive than they might have thought here a few months ago to combat inflation, and that's pretty bearish for stocks going forward, if that's truly how the Fed's going to approach this over the next few weeks and months. Okay, so getting into the technicals real quick, your 1-year daily chart on the S&P is not looking good, folks. Here's that 200-day moving average, that blue line, close below, falling below again. Sell signal right here on the MACD. This is your 5-year weekly chart. Broke down below our wedge here. Remember, we had these bearish divergences, still do. Widening sell, signal here on the MACD. Losing the 50-week moving average as I speak to you right here. Need a nice bounce by the end of the day to stay above that. That would be technically bearish, no doubt about it, if we close today below that 50-week moving average. And then looking at the monthly, the 10-year monthly chart, close below that, falling below that as well. About to have your sell signal on the monthly, and I think the last technical update we did, I told you how not good that is on a pretty consistent basis when you go back historically. So anything but a good look technically for the market when we look at the daily, the weekly, and the monthly charts. Now, if it's any consolation on behalf of the bulls out there, if you want to look at the real short-term stuff, taking a look at the 60-day chart, so a 2-month chart, hour by hour. Actually, this says that the market's, ready for a little bounce, perhaps. And as I just suggested, we're seeing that right now intraday. And these things, would help an intraday trader the way we're looking at this. But so this is your downward sloping wedge. You have divergences on the momentum indicator. So you have a lower low here, you have a falling wedge, and then you have a higher low on these. So that suggests that odds favor breaking out of that wedge. And pretty much the same thing on the 2-hour chart. Falling wedge, not quite the divergences. You would argue you don't have it there. So on the the little bit longer 2-hour chart, you could still be on balance, say on net bullish, but not quite as much as you would say on the 60-minute chart. So again, if I were swing trading this, I would have been buying the S&P earlier this morning, and looking to fade it maybe by the end of the day, but I'm not going to make any short-term predictions. But again, this says that this market, and I said this I think 2 or 3 times on the blog in the last week, that whether you're a bull or a bear, don't hold your breath on this one. This market's going to go through big swings in both directions on a daily, weekly basis, maybe even monthly basis. Overall, though, when you look at the more important longer-term technical indicators, and a lot could make those turn around positively, right now, they're not looking positive, bottom line. What is looking positive is the gold chart. So you may recall back here, we pointed out this island reversal pattern, right? This was just a very classic, ain't gonna make it here, and sure enough, it did, and it gapped down. Well, we went right back up to the top there and then burst through it here yesterday, right? And so this was just a really, really strong move. So gold's really helped our relative performance to what most other people benchmark, as you might imagine, so far this year. But we do have this big gap right here, and gaps tend to be filled. So again, technically speaking, you'd expect maybe on good Ukraine-Russia news, you'd expect gold to come back and test this line and fill that gap, right? So somebody who's short-term trading gold might take a pause right here, might even look at maybe going short, if we get closer to this, and this is the ETF that tracks the gold. So you might see a run and look for some serious resistance right in there, and you do have right here what would be divergence on the momentum indicators. For this to support this move, this needs to it needs to come up here before things begin to roll over, and then you're pretty good technically. So just a slight divergence here. Structurally, we are bullish on gold long term, but we do expect, as we've experienced since we've owned it, lots of ups and downs along the way. And then last but not least, silver. Right, so silver looks a little earlier stage. It's had a really nice run here of late, as you can see right here on the daily chart. And this is a silver ETF, so it looks early. So there's nothing here. This is not a negative divergence, by the way, because we don't have a higher high right in here. So this all looks like it's symmetrically placed pretty well to support silver moving higher. Broke through the 50-day moving average, and it's beginning to slope higher. Right, that's a positive. You're going to run into, a little bit of a wall here on that 200-day moving average. You can see the resistance it's offered. Right, it had been support. See that back here. Once it was broken, they fought it for a while. Then it became resistance. Boom. Right, resistance, resistance. People who lost, give me one more chance. So they have evidence that it's going to lose it at the 200-day moving average. So it could become somewhat of a self-fulfilling prophecy. Longer term, I'm liking the look of the silver chart right here. So folks, I am going to stop cold right there. Thank you, as always, for watching and listening, and much more to come. Hope you all have a wonderful weekend. Take care. Bye-bye.